Hi, everyone. Glad to see you have all decided to join us today. This is Gina from Birgo. I'm part of our investor relations team, and we're going to get started. So I'm going to hand things off to Andrew to discuss the views at Crescent Hill.
Amazing. Thank you all for joining. Really excited to be with you all. My name is Andrew Reichert. I am founder and CEO of Bergo Capital. A little bit on my background. I started the company back in 2012 based on my own experience investing in real estate. Since then, we've grown to 3,600 units and 100 employees, and we've been acquiring assets here in the Heartland for the past decade. And I'm really excited to have my colleague, Justin Burke, who leads our acquisitions efforts with us here as well. Justin, would you mind introducing yourself?
Sure. Thanks, Andrew. Hey, everyone. I'm Justin. I run the acquisitions function here. I source, evaluate, negotiate, and ultimately close deals for us. I'm excited to talk about our newest acquisition with you all.
Amazing. And just a little bit of an orientation of what we'll be doing today. We'll give you a quick overview on Bergo Capital. So I know a lot of you joining are already existing investors. Welcome back. We're excited to have you with us. For the new investors, we'll give you a quick orientation to who we are as a firm. Then we'll talk about this deal, the views at Crescent, and why we like it so much and how we're excited about closing the deal. And then we'll talk about the Louisville market. Interestingly enough, we looked at probably about 300 deals in Louisville. And this is the first one that we've been able to get under contract that pencils from an underwriting standpoint. And we are really excited to be entering into the Louisville market and building upon our continued geographic expansion. We'll talk a little bit about our track record and a few case studies for similar properties and similar business plans, and then we'll open it up for Q&A. The Q&A is open, by the way, so if you have questions, you can go ahead and post those in the Q&A panel at any point in the webinar, and we would be happy to answer those questions at the end. So let me start off by talking about Birgo Capital. Birgo Capital has been around since 2012. Originally just started based on my own experience investing in real estate. I had 20 units that I had purchased and was managing. And then in 2015, we launched our first fund, really grew our unit count, grew our geographic expansion. And since then, we've raised a little over $200 million from 300 investors all across the country, 25 different states. Our investors are in. We really think about the families that we're serving. We serve about 3,600 families today, and we're excited about the growth that we've experienced and the growth that we're continuing to experience into the future. A little bit about the team. Justin and I represent a broader 100-person team. We feel really passionate about taking care of our employees. Our mission is really, we believe that since we take care of our employees well, they take care of our residents, and our residents take care of our investors. So from our standpoint, we've had good top quartile returns. We'll talk about that a little bit here in a second, but we really attribute that to having an amazing team. We employ the property managers, we employ the maintenance people, and that's actually a little bit of a differentiator for us, being fully vertically integrated with the property management function. And we invest in what we call the forgotten middle. So it's the middle across three domains: middle demographically, so middle America; middle demographically, middle geographically, middle America; middle demographically, which is really to say Class B workforce housing; and middle financially, which is we buy a little bit bigger than the mom and pop investor, a little smaller than the institutional investor. So when you take those together, middle, we're really the player in that space, and we get first look at a lot of deals that trade in our markets that sort of match that buy box. And a little bit on our track record. Again, we've had a great run so far, right around 20% plus realized IRR on exited assets. We've never lost a dollar of investor capital, 100% profitable track record, 2.3x multiple on invested capital. And our DPI is really good in a world where distributions are really a differentiator. We've had great distributions out of our funds. We've never missed a quarterly distribution that was scheduled, and we're continuing to distribute capital back to our investors. And we've been around for a while. Again, we've over $500,000 of transactions, and our leadership team has tons of experience, billions of dollars worth of transactions, hundreds of years of experience. So we're really excited about the track record that we have, and we think this deal views at Crescent Hill is a perfect add-on to what we've done in the past. So Justin, why don't you walk through the deal?
Sure. Yeah, let's get into the deal itself. Happy to and excited to. Um, So yeah, views at Crescent, 132 unit workforce housing community located in Louisville's Crescent Hill neighborhood. It's one of the most in-demand submarkets in the city. We have it under contract for about $12.6 million, which is $95,000 a unit, and we're planning to hold it for 5 years. Solid bones, irreplaceable location, strong basis, and the heavy capex is already done. We love this deal for a handful of reasons. There's a lot to love. The basis is strong and supportable. We're buying the deal at about a 10% discount to recent comps, which gives us a lot of confidence in executing our business plan. The heavy lifting is done. The current owner spent over $3.7 million on roofs, HVACs, balconies, parking, interiors, and more. This allows us to focus our dollars on what really maximizes ROI. They also proved out a CapEx plan to drive $120 unit premiums across about half of the units, which we plan to continue. Location is also a big factor here, and we'll get into that a little bit more later. Let's take a look at the unit mix. 132 units, almost entirely two bedrooms. This is great for us because two-bedroom units attract a wider renter pool, which often means two paychecks backing one rent payment, lower turnover, and efficient use of space. It's a great balance of demand, affordability, and flexibility. Here's some pictures of the unit interior condition and the upgrades that the current owner has done. These aren't luxury renovations. They're exactly the right improvements for this kind of Class B renter, clean, modern, functional. That's how you get the premium without overpaying for the market. Here's some pictures of the CapEx that's already been complete in a list. Full roof replacements, HVAC systems, balconies, parking lots, new windows, and doors throughout. Again, it allows us to put our CapEx dollars where it really matters to really drive the ROI. And here you can see the pro forma telling a very straightforward story of a clean, visible path to value creation. Wanted to share some of these exterior property photos, how you can take a look at what you're seeing here is just a well-maintained brick exterior community, mature trees, generous green space, and great curb appeal. That matters a lot for the type of tenants we're targeting here.
Amazing. Thank you, Justin. Let's talk a little bit about the market. So I mentioned at the
Yeah.
beginning that we've had a lot of interest in the Louisville market for years and just haven't gotten the right deal under contract until just this point. So what do we like about Louisville? Well, a number of things. First of all, it's very similar to the markets we like to invest in that are undergirded by really stable economic drivers. So the things that really undergird the economy are, and Justin, maybe you could even talk about this a little bit. Really having healthcare, logistics, manufacturing, and employers. Those are some of the things we really like. Justin, you want to share a little bit about this as well?
Yeah, I like to summarize it as stable economic drivers, stable employment drivers, a really sticky tenant base, lack of new supply, and general affordability for the tenants in the market. Louisville exemplifies all that, and it's exactly the kind of mid-sized heartland market where Bergo's operational edge really matters. And we compare it to some of our other markets where we thrive, like Pittsburgh, Cleveland, Cincinnati, and some of these other markets where we already have substantial presence. So more specifically on the submarket, within Louisville, Crescent Hill is specifically a really attractive submarket for Class B multifamily. Rents run about 5% higher than the MSA. There's no new supply. There hasn't been any since 2022. And the infill nature of the community means that's not changing anytime soon. It's walkable, just 10 minutes from downtown Louisville, with a tenant base that's educated, employed, and they're genuinely attached to the neighborhood.
And what I really like about this, Justin, is it really does match that forgotten middle that we just talked about. And if you just look at the geographic profile and the demographic profile, which you're talking about here, and I know you're going to get into a little bit as well, it really is a great location for that Class B workforce housing, blue collar workforce that is super stable and really resilient, particularly in these kinds of economies.
Yeah, there's a really great combination of white and blue collar workers here with high incomes among both classes. And that really bodes well for kind of our affordability bend, where we're still going to be significantly under the affordability metrics that we like to see after our post renovation rents.
Yeah, and I think that that provides a lot of downside protection. You know, when you it really de-risks the asset when you know that the resident base in the local community is looking for this exact kind of asset. The other thing that I really like about this is it really is a supply constrained market. I think there's zero new construction coming online in this exact submarket. And that to me is a huge opportunity because, you know, the Class B right in the middle, when the market goes down, you know, Class A renters go to Class B, and when the market goes up, Class C goes to Class B, and that middle, particularly when there's not as much supply, is really an incredibly resilient part of really the economy there.
Especially when you couple it with the population growth that we're actually seeing in a 3 mile radius here and overall Louisville. You don't see that a lot in a ton of Midwest heartland markets, but this pocket is experienced population growth. So coupled with the lack of new supply, just plenty of demand drivers that are really attractive.
Yeah, amazing. Well, let's talk about, kind of our track record and where we've done this before. I'll kick this off. Justin, you're welcome to jump in. So this is our exited asset track record. I know it's a lot of numbers and words on a slide that are probably hard to read, but across 20 assets that we've exited, 21.3% gross IRR, 2.37x multiple. Let's talk about a few of them specifically. So Pinnacle Heights, this is in Morgantown, West Virginia. Very, very similar asset to this Louisville one that we're acquiring right now in terms of going into a sort of Class B asset in a strong submarket with good economic drivers. In this case, it was really hey, let's go in, let's renovate the units and boost the rents. So very similar to Louisville. That's what we did. And in 3 years, we generated a 31% IRR and a 3x multiple on invested capital. And we're really proud of those results. That's the exact kind of game plan where we turn these assets around and have good exits. Very similar story, Skytop Village Apartments. This one's 89 units, so a little bit smaller than the property we're talking about here. But we had such a low going in basis here. Again, we were able to get in, renovate the units, bump rents, and still keep it really affordable and have a great exit with a 26% IRR and a 2x multiple. And then last, this is very similar to this Louisville asset, 120 units. And this is in a submarket in Western Pennsylvania. Acquired it in 2017, actually. Did the renovations, kind of, improved the units, did some exterior upgrades, and had a 32% IRR and over 3x multiple on that one as well. So, these are the exact kinds of deals that we really like doing. We go in, honestly, deals that need a little TLC, like deals that have some deferred maintenance and have some opportunity to add value, are the exact kinds of deals that we like doing because they're just so ripe for improving the asset and adding value and both to the asset and to the community around it. So we're really excited about this deal. With that, we're going to jump into Q&A. Please do feel free to post any questions that you have in the chat. We would love to answer any questions you have. Gina, do you want to go ahead and read through the questions?
Yeah, we have a couple questions here. The first being, can you invest through an IRA, trust, LLC, or LP?
Yeah, good question. Yeah, we have investors invest all of those ways. So certainly you can invest through LLCs, LPs individually as a name. We also have some investors that like to use self-directed IRAs and dollars that are a little bit more tax advantaged to invest into this kind of vehicle. So we definitely have investors that do that. Happy to accommodate any of those structures.
Great. And then someone asked about, will commitments be called up front or drawn down over time?
Yeah, another great question. With this, because we're raising the capital and acquiring the asset, we're going to call all of the capital 100% upfront. And that's in part because we're closing on this asset actually in 2 weeks, so it's a bit of a quick turnaround. And in fact, we're just from announcing this webinar, we're actually, I think, getting pretty close to like 50% subscribed, just from existing investors and folks emailing and sending commitments in even before the webinar. So we're planning on closing the raise out pretty quickly and calling the capital all up front.
Okay, great. Given that the projected post-renovation rents are about $1,200 a month, can we confirm that this is a good safety margin for affordability?
I can grab that.
Yeah.
Yeah, I would call the affordability threshold about 30%. And when you actually look at our post-renovation rents of $1,200 on an annual basis, that represents just about 20% of a tenant's median household income. So I think we have a pretty large margin of safety there between where we're headed and what a typical affordability threshold is.
Excellent. Are there any tax benefits to investing in views at Crescent Hill?
Yeah, great question. Yes, so every asset we acquire, we do something called a cost segregation study. So for those of you that don't know what that is, you take a multifamily building and instead of depreciating it, the entire building over 27 and a half years, you segregate it down into its individual component parts and you say, well, the roof's going to last 20 years, the HVAC equipment's going to last 10 years, the fixtures and furnishings are going to last 5 years, and you hire an engineer to assign a value to each of those, and then you accelerate the depreciation on those. That usually ends up being very tax advantageous to our investors. Basically, whatever amount they invest, we can have a comparable deduction that will be passed through as a passive loss on their tax return. So it really creates a great tax efficient investment for our investors.
Right. What's the exit plan for this asset, and what happens if the market is soft when we decide to exit?
Yeah, that's a good question too. And wow, we got a lot of questions popping in here to the Q&A, so we'll have to see how many we can get to here. Exit plan, great question. We tend to exit assets one of three ways. One is selling the asset itself, and to the point of the person who asked the question, if the market is soft and there's not a person to sell to, we don't want to make a bad, selling decision in a soft market. So that's our preferred method, is just to sell the asset on the market. The second option is a portfolio sale. So sometimes even if the traditional brokerage, kind of market is soft, there's still opportunities to do a portfolio sale upstream. So that would be taking this and multiple other assets and packaging them together and selling them all to an institution, for example, maybe a pension fund in Louisville. We've done that before. That's a great way to exit, upstream to a larger investor. And then third, if neither of those work, we can always do a refinance and recapitalization. So what that looks like is we bring in new debt, we bring in new equity. The nice thing about the refinance and recapitalization is investors that want to stay in can stay in if they'd like, and then they don't have to pay capital gains tax at the end. So sometimes we'll actually do that and just continue to hold the asset.
All right, great. How do we keep our investors up to date on the syndication?
Yep. So if you're a new investor, you're probably not used to our quarterly reporting, but we have super transparent quarterly reporting. We provide, financial statements. We use a system called Appfolio Investment Manager. You would get a login to that system. You would see any distributions that you get. You see your capital account on there. You'll see all your quarterly reports on there, your subscription documents. But of course, we have an investor relations team as well. Gina, is one of the amazing people there as well. You can always email investorrelations@bergo.com. You can always call us. We really pride ourselves on being available to our investors.
All right.
Gina, should we continue to hit these questions? I know we're kind of running a little bit out of time, but I could I could take a couple of these additional questions in the Q&A here.
Yeah, absolutely.
All right. Couple things. So who will be the asset manager for this? And given that it's in Louisville, and then review of the current property. Yeah, this is a great question. So thank you for your question. Basically, who's going to be the asset manager? And the second is more of a statement, but the Google reviews on this property are really bad. And so they were saying, are you going to do a total rebrand or keep the same name? Um, that's a great question. We typically do a rebrand. So typically we come in, give it a new name, big signs that say under new management. Again, we love these kinds of assets because usually they're in a bit of neglect, and that's how we add value. And so we like getting into assets that have bad Google reviews. We set up a new Google My Business page and do a new name, replace the signage and everything. And that usually is a fresh start for people in the market. And usually that's honestly a breath of fresh air to both the existing residents and new prospective residents. The asset manager, actually all of our asset managers are in Pittsburgh. So even our asset managers that manage Columbus or Cincinnati and Cleveland and Buffalo, they're all in Pittsburgh. And so we really have our back office stuff all in Pittsburgh. In terms of property management, if that was more the question, typically when we enter into a new market like this, we will work with a third-party property manager at the onset, and then we'll look to bring that in-house when we feel like we have either a significant size portfolio there or just enough of a grasp of that market to bring it in-house. So that's the plan for this. We'll likely use a third party at the onset and then look to bring in property management in-house after the fact. Next question, what are some of the risks that you've taken into account? Great question. So a couple of the risks that I think about, one, interest rate risk. So one of the things that we really pride ourselves on doing is managing risk before it needs to be managed. Like we take a conservative posture and approach to risk management. A lot of our existing assets are long-term fixed rate debt, which is in part why we didn't get into trouble, when a lot of the other multifamily operators were getting in trouble over the past few years. And we're taking that same approach here. I mean, we're going to be doing some renovations, adding value. We likely will do a refinance to move this to agency debt once we finish those refinances. But I think that's the main risks are executing on our business plan to add value, and then interest rate risk as it relates to doing a refinance to likely Freddie or Fannie once the asset is fully stabilized. We've got plans for how to manage that risk. We have an entire in-house construction department. We also hire third-party contractors when necessary. But it's something we've done. We've done it over and over, and so we feel pretty confident kind of managing those risks moving forward as well. Gina, we have time. You want to keep going through these?
Sure. One of the next questions is, what are some future ROI drivers for Crescent? Dave, I think you're asking about the neighborhood.
Yeah, Justin, you want to hit that one?
Sure. Yeah, I think as you could see earlier in the demographic slide, people are still moving into this neighborhood, even though there's not a whole lot of places for them to move. So right there, that just kind of proves to us that rent can kind of just keep growing slow but steady. They're actually right across the street from this property is a little small retail community that's easily walkable from the property, and there was an old gas station there that they're actually completely revamping right now into a kind of like a newer mixed use type of environment. So it's a place that people want to live, and there's not a whole lot of options. So I think we're going to see a lot of growth in terms of population, and single family homes are a little bit too expensive. They don't quite fit the affordability metrics that we've outlined here. So I think people are going to be looking to live in these kind of apartments, especially ones that are taken care of and run well.
Is this asset going to be part of our Heartland Fund?
Yeah, good question, Vikesh. Yes, so we always acquire assets like this, and we like to retain a portion of it in our kind of flagship fund that we have going at that time. In this case, we'd love, to probably retain something like 20% of the equity in the Heartland Fund, and we're syndicating out the rest to individual investors that want to get in there. So for investors who are already in our Heartland Fund, you would get exposure to this directly from being in that fund. For investors that just want to, invest in this asset, the syndication is available to you. So really, there's two different types of investors that we have. Some like the fund, some like individual assets. So we don't syndicate.
Some like both.
Yeah, some like both. And we don't syndicate every deal. This deal in particular sort of bodes well for a syndication.
Excellent. One of the most fun questions, how do you invest?
Yeah, good question. So we can jump to that. Let me just see. I know, did we get to all the questions, Gina?
Looks like we might have a few more. Someone did ask if this would be included in any of the Birgo funds, and the answer is yes.
Yeah, we answered that.
And then someone asked about the tax benefits of an IRA.
Yep. So tax benefits in IRA. There are, tax benefits. So when you invest through an IRA, self-directed IRA, you basically get to grow that portfolio kind of tax-free. It's a retirement account. I'm not a CPA, so I'm probably not the best person to answer that question. I always tell you, consult with your tax advisor. But if you if you have an IRA and you want to invest through that IRA, I would definitely check with your tax advisor. Maybe just send a separate email to me on that as well. Great. And then in terms of investing, I'll just use that as a segue to jump to the next slide. So if you're interested in investing, we'd love to have you join us. You can send an email to investorrelations@bergo.com. We'll also send a follow-up. I think there was about 100 or so people that registered for this webinar, so we'll send you all a follow-up as well to send this recording out, and you can just email back to that email where we send the recording to indicate your level of interest. Even if you just tell us the dollar amount, and if you're investing as an individual or as an entity, that'll be enough information for us to kind of get things going, and we'll get you onboarded to our portal, send a capital call out, and we'll make it as smooth as possible to handle your investment. Gina's great with sending the docs out that are populated and ready to go for you as well. So we'd love to have you in this. As I mentioned, we've had a good bit of interest even here on the front end. So I suspect that we'll fully subscribe. And if you're interested, just let us know. Last thing, this is just our disclosure. This investment is just for accredited investors. So just wanted to make sure that everybody's clear that this is an accredited investor offering. So thank you all so much for joining. Really excited about this deal, really excited about its potential, and we'd be looking forward to having you all participate. Thanks, everyone.
Thanks, everyone.
Thank you.